In Investing 101 today, volatile moves in the stock market along with the Fed raising rates is shaking up the bond market. Joining us now, Todd Colvin, to tell us more about what he sees. Todd, what are your thoughts about investing in long bonds?
You purchase somebody else's debt, you get paid a coupon over a period of time. It seems like a win-win for everybody. I think right now, though, in certain environments, bond buying becomes a little more attractive than in others. And if you look at what's happening now, a lot of uncertainty in the world. We look at a declining stock market. We look at a Fed that maybe doesn't know what they're quite going to do, and you want to take a step back from that, maybe take some of that risk off. You look to buy a government bond with the idea that you will get paid. Not only you'll get paid a coupon, but you also get paid back your principal over time. And then you can look to put the money elsewhere, and you can look at denominations of as low as a few months to 30 years in order to invest your money. And the longer out you go, the more your return, the more your coupon and yield should be on that investment. So right now, I think with uncertainty kind of being the headline, bond buying is something that you're going to see is very common. I think that yields in the bond market aren't as attractive as one may have thought. If you go back over time, bond yields are historically a lot higher, which would offer the buyer a much better return. However, given the circumstances that we're in since the financial crisis, bond yields are on or near their highest that we've seen them since 2008. So right now, I think that the market is telling you that these are attractive bond yields. They are going to help you in the event of a crisis, uncertainty, something triggering that the Fed or that the markets aren't pricing in. Bonds are going to help you there.
I'd love to get your insights on bond ETFs.
Bond ETFs, as opposed to buying an outright bond, it enables you to buy what we'll call a basket of bonds, and it will reflect an index. So you want to kind of get a fair assessment of where bonds should be, but you don't want to be all in on one specific bond. You can buy a bond ETF. The benefits are this. You don't have to put all your money in. If you're buying a $100,000 or $1,000 bond, you have to spend $100,000 or $1,000. An ETF will trade similar to a stock, and it'll be exchange traded, and you can buy, pay whatever the stock price, whatever the ticker price is at the time, and you will, as the bonds appreciate, you will see the stock price or the ticker price appreciate. Likewise, you will get a coupon, but it'll be sort of a warped coupon. It won't be exact because you're talking about a basket of several different bonds with possibly different maturities, so you'll get paid a smaller coupon. Likewise, the biggest difference, I think, between an ETF and an outright bond is the principal. You look at an ETF, you're not really buying a bond. You're buying kind of a reflection of a bond, so you're not going to get a principal payment back at the end of the term. Whereas if you buy a bond, you're going to pay a bond, you're going to receive a coupon payment every quarter or term, and then you're going to receive your principal back.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.